Owning growth stocks that can compound at double-digit rates over a decade can be a phenomenal way to beat the market. And in fact, a lot of the companies that have 10x'd over the past 10 years have done exactly that. So I have 5 here that I want to highlight today that are just tremendous growth stocks, some of them growing well in excess of 10% and have a long growth runway ahead. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Now let's get to the first stock, and that is On Holdings. If you're not familiar with On, this is their main product is running shoes. They were founded by some long distance runners, did things like Ironman races, and this cloud technology at the bottom of the shoe is really what the company is known for. Sponsors a number of great long distance runners, particularly some of the best female runners in the world, winning races like the Boston Marathon, and their shoes have actually become more of a fashion item in recent years. So used for high-end running, but also now for fashion, and they've added a lot of apparel products too. So this is the core business for On, but let's go to the financial results because this is where things get really impressive. I'm going to start with On's revenue and gross margins. Revenue, a compound annual growth rate since 2019 of 61%, just a phenomenal growth rate, and management guides for growth in excess of 20% over the next 3 years. They're actually slightly ahead of that schedule, so possible that they're going to grow closer to 30%. And look at these gross margins. Gross margin of nearly 60%. That's just a phenomenal margin. Both the growth rate and the margin rate beats an industry leader like Nike. But this is the other thing worth highlighting: net income and free cash flow. A hard goods company like On Holding that has to build inventory, hold inventory on the balance sheet, deal with the potential of discounted products, it's very, very hard to be profitable and grow at the rate that On is growing. But they've done exactly that. And you can see that with this net income of $79.6 million in the last year. That actually includes a large loss related to conversion into Swiss francs, which is what all of these charts are in. They're in Swiss francs, but a lot of their cash is in the US. So currency fluctuations have actually had a negative impact on the bottom line. That will smooth out over time, but that's just a one-time impact. And free cash flow actually very strong in 2023. The great thing for On is I don't see the company's growth slowing anytime soon. Not only is it getting more popular in some of its more mature markets like the US, it's expanding into certain areas in Europe, expanding in Asia, expanding into more sports, so adding more tennis shoes, and also into apparel. So this is a company that has a long runway ahead of likely 20% revenue growth, and the valuation of the stock is relatively reasonable. Enterprise value to sales multiple as I'm recording is 5, and the price to earnings multiple on a forward basis is 41. Now that sounds expensive, but like I said, net income and free cash flow are going to be negatively impacted by the really high growth rate that you have at On Holding. So long-term, buying at the current price could actually look extremely cheap. That is one of the reasons that I'm so bullish on Holding. Once you see a brand like this get extremely popular, it's best to just buy it and ride the wave of popularity. That has worked phenomenally well for companies like Nike, Lululemon, and I think On Holding is going to be the next in that line. The next stock with an absolute growth tear is Celsius Holding. Now, this is a much more expensive company, but just look at this growth chart. Revenue has grown at a compound annual growth rate of 105%, just an incredible rate of growth since 2019, and it doesn't look like things are going to be slowing down anytime soon. Celsius is getting better placement in stores in the US, after expanding its geographic footprint tremendously here over the past couple of years. So that's going to drive incremental sales growth domestically. But the next phase of growth is really going to be international growth. And we're really just seeing the tip of the iceberg there for Celsius Holding. The company has announced a few countries that it's expanding in over the past few months: Canada, the UK, Australia. But this is really almost an untapped market for Celsius Holding, and this is a very capital light business model, so it should be able to expand around the world, leveraging distribution partnerships with companies like Pepsi. One of the great things about Celsius Holdings is that they don't actually do most of the manufacturing of their products. They offload that to what they call co-packers, who are the ones that actually mix and can their beverages, and then distribution partners pick up their product and actually put it on retail shelves. So Celsius, in a way, is really just a company that's formulating products and doing branding and marketing. So very asset light, allows this tremendous growth curve that we've seen. Now, like I said earlier, shares are not cheap today, Price to earnings multiple on a trailing basis is 103 as I'm recording, and on a forward basis is 72. But this is one of the things about growth companies that are growing in excess of 100% right now is they're often very expensive. So this is a stock that I own, have held for less than a year now, but have had a nice gain, and I'm not looking to sell anytime soon. In fact, I'm looking to add on any weakness in shares. So just one of those phenomenal growth stories that I don't think is ending anytime soon. Will be great to hold for the next decade. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The third company is Coinbase. Coinbase is known as a cryptocurrency exchange, but it's really much more than that. Yes, it has a big exchange business. Yes, it's expanding that business around the world, but there's other businesses that Coinbase is involved in that generate a tremendous amount of money. The first to know about is stable coins. Stable coins like the USDC token are actually backed by real assets, by real cash, and that money can be invested in low-risk securities like treasuries. Now that interest rates are higher than they were a couple of years ago, the $20+ billion that is backing the USDC token is generating interest revenue. And as a partner in the USDC token, Coinbase is generating nearly $1 billion per year just on those stable coins. So that has become a huge business. And then the infrastructure business that the company is building, with including the Base blockchain, including MPC wallets, including smart contracts. These are all things that Coinbase is going to be able to use to build infrastructure to disrupt the current financial systems, working with companies like BlackRock and Circle to create that infrastructure that's going to move all kinds of financial assets onto the blockchain. I think this could be a company that is a combination of identity like we use with Google. In the future, you might sign into websites and applications with your Coinbase app. It could be your financial institution or your bank, and could also be a cloud services company like AWS. If the blockchain continues to grow in the use cases and potential disruption of the financial services industry, I think Coinbase will ride that wave. And so that's why it's one of the companies that I plan on holding for at least the next decade or two. Also happens to be led by a great founder in Brian Armstrong, who is a visionary in this space. The fourth stock to mention is Spotify. Spotify is one of my long-term holdings, one of the first stocks I covered on asymmetric investing, and is just a phenomenal growth story in music and expanding around the world, growing its user base by 20% plus per year, growing its premium subscription, and is now moving into the advertising business. I think that's going to be fundamentally where there's a lot of growth, particularly on podcasts, where podcasts are monetized at a rate of about 1/100th of the value that radio is monetized at. So a lot of opportunity to grow in monetizing podcasts, especially through advertising. I think that's going to be a phenomenal growth stream. But really, Spotify is an aggregator. If Spotify is the first place you go to find the audio things that you're listening to, whether that's music, audiobooks, or podcasts, that is a win for Spotify, and it can be a win for creators. So Spotify just sits in the middle, creating the platform and monetizing for those distributors. It's not unlike YouTube, where I'm putting this content right now, where I, an individual creator, can put my content on YouTube. YouTube will help with distribution and monetization, so it's a win-win for both of us. Spotify plays a similar role in the audio business. That's why it's so attractive right now. That's why adding audiobooks and podcasts to the music platform has been so valuable. It's taking market share from companies like Apple and Amazon. I think Spotify is a company that can grow in excess of 20% per year for the next decade, as not only the premium business grows, but also the advertising business becomes more and more valuable. It's tough to look at their valuation today because Spotify just turned the corner to profitability and more free cash flow as it's cut operating costs, but that operating leverage is going to only improve in coming years. I think there's a bright future ahead for Spotify. The final stock is Portillo's. If you are not familiar with Portillo's, Portillo's is a restaurant company that has a cult following, started in the Chicago area, but is now expanding in the Sun Belt, has 85 restaurants. Those restaurants are generating an average of $2 million per year in restaurant level EBITDA, a proxy for cash flow from restaurants. Why is that $2 million number important? Well, Chipotle, which is a gold standard in the restaurant industry, generates a little over $2 million in revenue per restaurant. So Portillo's is generating more like $8 to $10 million per revenue and $2 million in cash flow. Its best restaurants are generating in excess of $15 million in revenue. Portillo's makes hot dogs, beef sandwiches, and is known for its chocolate cake as well. Management talks about the menu being veto proof. There's something for everyone in the family. And it's really interesting how they have built their restaurants with a double drive-through lane. You can do pickup, you can sit down in the restaurant. There's not only something for everybody from a food standpoint, but also from a convenience standpoint. The hardest thing in the restaurant business is getting to the point where you can generate positive EBITDA and cash flow from each restaurant. Once you get there and once you're popular enough to grow, then it's just a matter of expanding those boxes in state after state after state, getting leverage and learning more about how you're going to scale that business. That's the phase that Portillo's is in today. Only 85 restaurants today. Management thinks they can get that to 900 restaurants, expecting to grow the restaurant count 12 to 15% per year. That means revenue is probably going to grow in excess of 20% per year for the foreseeable future, 10, maybe even 20 years in the future. So this is the kind of company that I just want to ride for the next 10 or 20 years. Shares currently trade for 40 times earnings, so not the cheapest company, but like I said, a lot of growth potential, and there's the potential for margin expansion as well as we move away from the costs that are associated to building out these new restaurants and start to get some more operating leverage in the business. So love where Portillo's is at today. I think this will be a company that investors will look back 10 years from now and wonder why they didn't buy it earlier. So that's one that I will keep covering on this channel. But the 5 stocks that I have for you today that I think are phenomenal growth stories: On Holding, Celsius, Coinbase, Spotify, and Portillo's. Which one of those is your favorite? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.